Like what does DeFi stand for? Let's start there.
It stands for Decentralized Finance.
So why don't you now kind of lay the framework for what DeFi is? It's almost a buzzword at this point. I want to say I saw a chart where it had even surpassed Bitcoin in some Google search metrics at one point. Like it seems like everyone is talking about it right now.
Back in like 2017, 2018, a lot of the focus on Ethereum was building a lot of democratized things of different fields like supply chain, like community stuff, bounties, a lot of different networks. And then as the developer space in Ethereum kind of grew, one thing that really just kind of took off is decentralized finance.
One thing that's maybe hard for people to wrap their head around, and also a byproduct of everyone coming out of that first Bitcoin bull run in 2017, and you had all the ICOs popping up, and you had a lot of this stuff that, you know, you had this vision for crypto, and you could see the kind of utopic vision for it, but then there were all these people trying to ride those coattails and making up these products and ICOs that didn't actually have value. How do people kind of untangle now that we have this kind of DeFi era with all this stuff popping up? Like, what is the kind of utopic vision for DeFi working out? And what are maybe some of the things people need to look for if they're just trying to get rich? Because that is a lot of people like, which coin do I have that's going to go up 2x versus like the actual use case real world scenario for these things?
One of the things that is much easier this time around, I think, when it comes to evaluating projects is you can actually see where the money is. You can, previously in 2017, all these ICOs were just ideas. They were just white papers and ideas, and some of them worked out and a lot of them didn't. Whereas right now, you can go and look, and because the blockchain is open, see that there are, $40 billion locked in DeFi. This has been my kind of go-to place. And so here you can see this is a super easy snapshot of what's happening in DeFi. Where's the money? So you can see that Maker, Aave, and Compound, as I said, lending is huge. The three largest total value locked all over, or pushing 5 billion, which is crazy. And even just a few months ago, we were celebrating like 5 billion locked, and the first protocol getting over 1 billion total value locked inside of it. And it's just kind of gone parabolic.
What's the difference between earning and farming?
Farming is generally used when talking about putting your assets to work in a protocol that is paying you with their token. So if you are providing liquidity on Sushiswap, you're farming sushi tokens. Whereas earning, to me, is more just putting your assets to work in a DeFi protocol that is paying you interest or something because your assets are valuable to someone else who wants to pay you interest for them. For example, on Compound, you can put your USDC on Compound right now and earn like 7 or 8% annual interest because there are other people who are willing to pay 15% to borrow that Compound from, or that USDC from you on Compound. So that's the main differentiator there.
What are the use cases? Who's actually buying up these tokens or my assets? Like, what are the things they're doing of putting these to use?
So for the exchanges, I think that they're actually the easiest use case to explain. Is I haven't used a centralized exchange other than offloading capital to pay taxes in like 2.5 years. I don't have a Binance account. I don't have a FTX account. I don't use any of those things. I only trade on decentralized exchanges. They're always up. They're always running. They give you really good rates. There's a ton of liquidity. There's billions of dollars of liquidity. And now they're doing billions of dollars of volume. And so I think those are just, especially just, there's serious demand. People want to trade on these things, and it's really easy to integrate your applications on top of them because it's all open and all decentralized. And so it's not even just degenerate stuff. There is a lot of degenerate stuff that people can do with it, but it's a serious use case of always up, can't crash exchanges, which is super valuable. Just with Robinhood, even, or like when Coinbase goes down because everyone wants to buy, I don't have that issue. I just open up Uniswap or Sushiswap.
What platforms is that, to be clear?
So there's 3 major exchanges where that's the case, and that would be Uniswap, Sushiswap, and Curve. Uniswap and
Gotcha.
Sushiswap are kind of all assets, anything goes. Curve is more focused on stable assets swapping between each other. And then the 2 main money markets where you can lend or provide your collateral for other people to borrow are Compound and Aave. So I would say, just to reiterate, Compound and Aave for money markets, and then Uniswap, Sushiswap, and Curve for exchanges.
Then how do I hold my keys while lending it? And then where do you go and lend it?
I'm going to stick with Compound because it's the easiest, and then I'll get into a couple other ones. But so the way that Compound works, and Aave essentially works exactly the same. Well, their code is different, but the idea is pretty much the same. And so they are money markets. So one thing that's important to remember is every loan that you take out through one of these things is actually over collateralized. If you want to borrow $100, you have to put up $150. Not exactly, but general idea. So if I want to borrow $100 of Ethereum from Compound, and I have $200 of Bitcoin, you can deposit your $200 of Bitcoin into Compound and borrow $100 of Ethereum. Then the way that it works as far as defaulting on your loan is as you have borrowed this Ethereum, it's going to accrue interest about how much you owe back. I don't know how much it is right now, but it's not a ton, maybe 4 or 5% a year. And Compound basically has a running tally of how much you've supplied and how much you owe. And they use oracles to keep track of the prices of everything. And if at any point your ratio of how much you've supplied to how much you owe drops too low to where your loan is now under collateralized based on what their rules are, you can be liquidated. And in that case, there's a decent network of bots that will liquidate your loan. And what that does is it would take your underlying assets. So say, let's stick with the same scenario. You deposited Bitcoin, you've borrowed Ethereum, you're now at the point where your loan's going to be liquidated. So I don't know what their exact numbers are for liquidation. Let's say you have now $200 of Bitcoin still locked up, and you owe $175 of Ethereum. What would happen is it would take your $200 of Bitcoin, it would sell off $175 worth of it for Ethereum, because that would be how they recoup the loan that they gave you. And then they also would take a pretty steep fee, around like 15% or so, on top of what you owed because your loan liquidated. So that's how they go about securing the entire marketplace. So that way, there isn't really a way to game that system and just steal money from them. You would have to have some type of outside error there.
If you just took like a use case of someone, let's just say they have
one Bitcoin or one Ethereum,
right?
Like, what's that look like?
Yeah, what would you like? Do you think it's smart to put those assets to work in some way? And if so, what would be some of the better bets you could make if you were wanting to make that work for you in more ways than just the natural, deflationary stuff with Bitcoin or Ethereum?
As far as like Ethereum and Bitcoin goes, generally the most consistent way to earn interest on those through the last year or so, where you can maybe just kind of try to set it and forget it, is being a liquidity provider. And that gets into what I saw a couple people tweeting about before this, like farming sushi, or at a time you could farm Uniswap. But being a liquidity provider, I mentioned how pivotal, important Uniswap was to DeFi. And so again, the way that works is you have an automated market of 2 tokens. So let's say you have an equal amount of Ethereum and Bitcoin. You have an automated market of 2 tokens that people can trade against, and the code inside of the smart contract will adjust the prices for each one appropriately as people trade against it. You can, as an end user, provide liquidity to that marketplace. And what that does is you would put in your Ethereum and Bitcoin into this market and be one of the market makers. And you earn fees for doing that. So the more trading volume there is, the more you're going to earn. But right now, if you were to provide liquidity to the Bitcoin Ethereum pair on Uniswap, you'd be earning for today 10% if it was prorated over a year, which is pretty good. To compound on that a little bit, you can on Sushiswap also stake the liquidity that you are providing, and you would then earn sushi tokens. And so sushi tokens are the governance token for Sushiswap, and they have to this time been very desirable. And so that adds on an additional 24.5% annual interest for providing liquidity with Bitcoin and Ethereum. So you can, with a pretty safe, easy set it and forget it, earn pretty significant ROI on your assets.
Growing up, you're taught like if it's too good to be true, right? Like it's probably too good to be true. And it sounds like if you have cash or you have crypto, like this is a very plausible way to just make a return that, like you said, your bank account's not going to do it. Even some index funds now aren't going to trade at that percentage. Like what is the risk here?
The primary reason, and the most important kind of the reason that everyone's building the stuff we're building, is that in building this decentralized, you're cutting out a lot of middlemen. You're cutting out a lot of people who are going to be taking fees and cuts of what you're doing. And so
Right.
when you're basically directly connecting users who are providing market making to users who need liquidity to trade, you can pay them a much higher rate because you're not paying for infrastructure and all these different things that you would have to otherwise. And so that is the main thing that allows you to have really good rates. You have an outsized risk of some type of failure that does not exist in most of the current financial system, because it's not really super regulated. There isn't this isn't all insured. If this all if something happens, you can't just call up your insurance and be like, hey, I just lost all my sushi tokens, can you help me out? They're not going to know what you're talking about. All of these things, as no matter how much money is locked in them, are highly experimental. I would not put any more money into crypto in general than you are willing to lose. I'm a big time gambler, so I have a lot of cryptocurrency, but I would still, big word of caution there, just like all of it there could be catastrophic. For example, Aave basically after launching their version 2 found a bug that would have been catastrophic for all their code, but they caught it and fixed it, thankfully. But there are serious risks, especially in new things that are launching.
So I guess, I get concerned because it does when you say other people are borrowing your money to do even more risky things with it. That feels like a house of cards, whereas if you told me, okay, this company wants to set up this Bitcoin mining eco-friendly farm and they need, $100 million to pull this off. And I'm like, okay, they're building something. It's going to what are my concerns founded that it feels like a house of cards in that description?
For the most part, the core protocols that I've been talking about so far, they have user safety built in, or protocol safety built in, that when something, when I'm borrowing the assets that you're providing to go do other degenerate stuff somewhere else, if things were to go bad for me, I'm the one who loses money, not the person who's lending. And that's how they're built out. Outside of protocol risk, bugging the code, something like that, most of the risk right now comes from borrowing.
Gotcha.
And so the rates that you can earn just providing capital are as safe as you're going to have in the crypto space.
So what would be the training wheels version of what you're doing, the extreme, the non-leverage long, kind of back to Jack's question, if you did have one Ethereum and you really wanted to maximize it and you were willing to be like, I'm putting this in, I know this is speculative, I know it could go to zero or this could be, but what would be kind of the smart ways to use that one Ethereum?
Honestly, if you had one Ethereum or something, I think that's a really good point, Peter. You probably don't want to do anything with it. Maybe if Coinbase has got, I don't know, if Gemini or Coinbase, someone wants to give you a couple percent for it or something like that because they're going to use it better, because they're going to lump up thousands of users Ethereum together and go do something with it. Sure. But as Peter was saying, over the last couple months, the cost of transacting on Ethereum has gotten really, really high. It's going to cost you $150 to get into a position of providing liquidity and staking that on Sushiswap. And so, let's say you're earning 40% interest annually. If you put in one Ethereum worth, let's just for the sake of math say it's $2,000. You're not going to make that much because if you're paying $150 to get into this. Yeah, it's highly addicting. Honestly, I'd say outside of all the stuff I've talked about, the biggest risk of doing all of this is that it's just going to completely crater your day job productivity. It's just going to ruin everything else for you.